Introduction to Accounting. Preparing for a user's perspective. Expanded accounting equation, computing changes in retained earnings. You should already be familiar with the expanded accounting equation as introduced in prior videos. The only thing I'm going to change is instead of calling this capital contributions, I'm going to change that to be capital stock, as you would see in a corporation. This represents the dollar amount of stock issued to owners for which the company received assets. What I'm trying to do now is help you understand what causes these two equity counts to change from one year to the next. Capital stock will increase when new stock is issued to owners. Assets will go up and capital stock will go up. Capital stock account will decrease when stock is repurchased. This overall capital stock will go down as stock is repurchased. Later on you'll learn about treasury stock, but we won't worry about that right now. The point is that this overall capital stock issued and outstanding will decrease. Retained earnings increases when the company earns earnings. It will decrease when it incurs losses. Obviously we want to increase retained earnings. Now if the owners want some of those earnings out, they can vote and have a dividend declared and paid to them. So when dividends are declared, the company's retained earnings will decrease. You should recognize that these items are descriptions of how these balance sheet accounts change from one year to the next. Let's go ahead and work out this problem. I will first set up the problem as we have been doing with the beginning balance, the ending balance, and the change. We will do that for assets, liabilities, capital stock, and retained earnings. But then we will say that these changes will be described by stock issuances and net income, stock repurchases, and dividends. Beginning assets are 50, liabilities are 20, and capital stock beginning is 5. The unknown in this case would be beginning retained earnings. During the year, assets increased 70. Liabilities decreased 5. No changes in capital stock occurred during the year, so no net changes. They could have had some increases and decreases, but they exactly offset, so there are no changes. Dividends paid during the year were $10. Compute ending retained earnings and the net income earned during the year X1. We can now start solving for the unknown. Right now there's a lot of empty places. All we can do is really work with what we know. We can compute beginning retained earnings because 20 plus 5 is 25 plus something equals 50. You might recognize that number from a prior problem, 25. We still can't compute this, so I guess we're going to have to work through and figure that out one by one. Assets went from 50, increased by 70, so that would be 120. Liabilities decreased by 5, so the ending would be 15. That's back to this old formula. Beginning plus change equals ending. Put in the 20 minus the 5 equals 15. 5 plus nothing equals 5. We have enough information that we can solve for ending retained earnings. Negative 5 plus nothing plus something which we don't know yet equals 70. This would have to be 75. 75 minus 5 equals 70. So this change in retained earnings was caused by net income, which we don't know, minus 10. So what would net income have to be? It works like this. The change in retained earnings is going to be equal to net income minus dividends. We know that the change is 75. We don't know what net income is, but we do know dividends. If we add 10 to both sides, we will realize that net income must be 85. Minus 10 equals the change in retained earnings. If we know that the change in retained earnings was 75, we started with 25, it increased 75, this would have to be 100. So to prove this out, we're going to say these assets are claimed $15 by liabilities plus $105 by the owners. 105 plus 15 equals 120, and we've got this question solved. Ending retained earnings are 100. Net income earned during the year is 85. We've done it.